All right. Good evening, everyone, and welcome to another episode of Aim with DNK. As always, I will quickly wait for 10, 15, 20 seconds before audience starts coming in. Today, we're going to talk about art of fundraising for startups. So I'm particularly very excited about today's session. And yep, let's see how it goes. So yeah, welcome to another session. Okay, we are live. Fantastic. So good evening, everyone. Once again, first of all, happy Independence Day to all of you, and thank you so much for joining me today at 9 p.m. on AIM with DNK. Welcome to yet another episode of AIM with DNK. Today, we're going to talk about art of fundraising for startups. Uh, for all those who don't know me, before I begin talking about art of fundraising, and for all those who do not know me, I'm Dilnawaz Khan. I'm founder of a company called Codesign Labs, and I also run another company called Power Deck. Basically, I'm an entrepreneur with a decade-long experience into design, technology, and startup incubation industry. Prior to starting my own company, I used to work with Startup Oasis, CII, and Unitas Ventures. So I have almost like a decade-long experience into startup ecosystem, startup incubation space. And the idea behind this entire series is to kind of share my knowledge, talk to you all on a Saturday night, and yeah, try and answer a few questions. So AMA with DNK is a weekly Saturday night live series that I host exclusively on my YouTube channel, where I talk about something that I am very, very passionate about and something that I really, really love from the bottom of my heart, and that is startups. So on AMA with DNK, I talk about startups, pitching, funding, any and everything around startup ecosystem, and basically any and everything that can help you to become a better entrepreneur. And of course, as the name suggests, I also answer a few questions from you guys, which I have received either on my Instagram, Facebook, LinkedIn, or whatever is going to pop up in the live chat. So if you have any questions during the session, of course, drop them in the live chat. And I have, of course, compiled a few questions which I have picked up from other different social media platforms. And of course, if you do not follow me, go and follow me on Instagram, Facebook, LinkedIn, and other social media platforms. So as I said, if you have any questions during the session, feel free to drop them in the chat, and I will pick them up as and when I can during my session. And most importantly, if you haven't subscribed to my YouTube channel till now, go and press that red button below. Go and subscribe now, right? Okay. So as I told you earlier, today I'm going to talk about art of fundraising for startups, and I'm very, very excited because this is one topic which is I think most widely, and it's one of the top topics which everybody talks about in the startup incubation industry, rather technically startup ecosystem. And uh, every entrepreneur has the fascination of raising funds the moment they start, right? And in fact uh, uh, raising money is uh, rather a motivator also for a lot of people who are who want to get into the startup ecosystem or startup space, or wants to build their own company. So I think talking about fundraising becomes very, very critical, especially when there are so many myths around startup funding. There are so many investors you will find online, LinkedIn, social media. People kind of keep on getting confused. uh, uh, People do not know how to kind of get the first round of money to kind of get started from. They think that investors might give them money. They don't know when to start, when to raise money. Sorry, my bad. When to raise money, how much to raise. So there are hundreds of questions like that create a lot of confusion in startup entrepreneurs mind, especially aspiring entrepreneurs and early stage startup founders. And today I'm going to talk about all those questions, and I'm trying to kind of simplify the entire art of fundraising process for you. So yeah, that's what we're going to talk about. See, another before I jump into the conversation, I think another very, very important and critical reason why I want to also talk about this, that 90% of the startups fail in first 3 years. And I think I've already spoken a lot on this particular topic back in my episode number 1 as well, and even in the last episode that I did around pitching. I think I've already spoken a lot about that. But the critical factor that all of you need to also look and analyze is that uh, less than 0.05% of startups are able to raise any kind of a venture capital, right? So if you are a startup founder who thinks that you want to do a startup because you'll be able to raise money, or you want to do a startup because you think investors are going to come your way and going to give you money, I think you're absolutely wrong, or in you have a wrong mindset, or you have somewhat adopted a wrong a picture or a wrong image of startup ecosystem. So right, as I said, you do a startup because you're passionate about building a company. You have identified a problem, and you want to create a solution, and you of course have the skill set. And again, as I said, I've spoken enough about this in my episode 1. Go and check that out. But uh, ability to raise funds from the investors, or willingness to raise funds from the investors, or the intent that, okay, if I do a startup, investors will come and give me the money, should not be the core motivator for you to start up, especially in such a highly volatile environment, where we know that less than 0.5% startups are only able to raise venture capital. And of course, I will be decoding a lot of critical terms for you as well, something like a seed, angel, venture capital, all these kind of terms. So we are going to, of course, stay till the end. Stay tuned. I will be talking about all these terms as well. I'll try to even tell you a few sources from where you can raise money, and even and most importantly, that if you are a student, or if you are a very early stage startup founder, what are the tips and tricks that you can get money or raise money to at least begin your startup journey, right? So as I said, that because there's so much of confusion, there's so much of gray area, I think one of the biggest reasons why people get this wrong image about startup ecosystem and about fundraising is because we have seen, especially in the Indian ecosystem, I can't of course talk about how the Silicon Valley ecosystem works, but what we have seen in the Indian ecosystem especially, that the founders of funded companies are glorified, right? And uh, any and every startup, when they raise money, they're either being covered by digital media, blogs are written on them, TV interviews are done. So therefore, raising of money starts looking like a destination or the ultimate process than building a business. And I think this is where the distraction happens, and this is the reason why even after raising a lot of money, startups fail. So first, I'm going to talk about a few myths or a few misconceptions that I have personally seen startup founders getting affected by. So first, let's talk about a few myths, and let's clear them out of the way before I jump into the fundraising process. So number one thing that I have seen happening with a lot many first time startup founders, aspiring entrepreneurs, and early stage startup founders, student entrepreneurs especially, that they think that ideas get funded. And in fact, I have done 2 to 3 such posts on my Instagram in few span of few days. Go and check them out on my Instagram account, of course, but not right now. Wait for a session to end. uh, you know uh, Ideas don't get funded, and the very basic simple logic behind this thing is, let's decode this entire line or equation. uh, Investors invest in a business, right? And uh, who is an investor? So investor is anybody who has some sort of a surplus money, and he's looking to put that money somewhere else, so that he can get some sort of an ROI. So for an investor, the real estate can be an ROI. He can, buy a property and sell it after some time, and he would get an ROI. Gold can be a good investment. Mutual funds can be a good investment. Shares can be, stocks can be a good investment. So therefore, just like all these asset classes, wherein investor can put his extra money, and he can get an ROI. A startup is also similar asset class, and of course, the earlier the stage of the startup is, the high risk it becomes. So therefore, it simply tells the equation that high risk, high reward, and therefore, this is one advice that, in fact, I have spoken to so many angel investors, and I keep on telling them that only put your money or become an angel investor, and we'll talk separately on this topic someday else. That if you are becoming an angel investor, only put in the money that you are fine losing. So only invest the money in a high risk startup or early stage startup that you're fine losing. If you lose this money, you can still sleep at night. Only put in that money out there. But so like, coming back to the point that ideas don't get funded. So what an investor is looking for? An investor is looking for an ROI. Where the ROI is going to come from? The ROI is going to come from a business, right? So as I said, either he's going to put money into real estate or gold or mutual fund or stock or a business, and the business will show him some kind of a potential of an ROI. An idea is not a business, right? So therefore, this is the reason why ideas do not get funded, especially by investors. Of course, there are a few ways ideas can get invest get can raise money, and I'll speak about them later on, especially from early stage guys point of view. But uh, if you are expecting an angel investor to fund your idea, or if you're expecting any venture capitalist to fund your idea, I think you're absolutely wrong. So ideas, number one myth that I want to clear: ideas do not get funding or funded, right? Second thing I want to talk about, that not every startup is able to raise money, right? So just like not every startup, just like not every business is successful or can become successful or can sustain. As I said, 90% of the businesses shut down in first 3 years of their operations. uh, Only a few limited startups, and I'm using the word very specifically startups, only a few very limited startups with a potential of infinite growth, or a very high growth potential, only are able to raise a good amount of venture capital. And of course, it's a separate thing that yes, a lot of them also get shut down even after raising millions and billions of dollars. But that's a debate, or that's a topic for another day. But not every startup is designed to raise money. So there has to be a certain design, there has to be a certain equation, and which I'll tell you at the end of the session, that what is the optimal equation, what is the right way you should be able to position your business, or your startup, most importantly, that it looks like a fundable company. Of course, funding or not funding, nobody can determine it prior. But I can only tell you the probability or the possibility, and I will tell you the equation if you stay back till the end of the session, that how can you as a startup can create a business model, can make your startup look like a fundable startup. Before I move ahead, I'm sorry, I need to remove these two particular things so that the distraction goes away. Okay, now okay, let me but keep on. Yeah, okay, now the third part. uh, and I think partially I've already spoken about this in part number two. Funding also does not guarantee success, right? So a lot of times I have seen entrepreneurs feeling that if they're able to raise money, they will become successful. And in fact, I as an entrepreneur, I have realized that I have failed a startup even after raising money, right? So funding is not the ultimate goal. Funding does not guarantee success. We have seen startups at early stage getting failed after raising money because of the investor conflicts, or maybe because they were not able to sustain the operations, and maybe in some cases because the market dynamics change, and because in some cases they could not understand where the funding should go, and they became so large that they were not able to control themselves. So bad expansion, bad utilization of fund, there are hundreds of reasons why you can still fail after raising money, even a series A or a series B. So therefore, do not build a company, do not start a company, or do not get into the fundraising process because you think that's the ultimate rule of success. I have seen so many profitable and sustainable and high growth startups and startup founders who have not even raised a single penny or single rupee from the market. One of the biggest examples is Zoho. And I have already spoken a lot. I've given a kind of a case study on Zoho in my previous episode, where I was speaking about survival strategy for startups. I think it was episode number 6. If you haven't seen that, go and watch that after we end today's live. So I think funding. Remove this myth from your mind that funding guarantees success. Funding doesn't guarantee success. Uh, Fourth point: a lot of times entrepreneurs believe that investors want them to start up, or they believe that if they start up, investors will come. This is something I kind of tell to all the entrepreneurs I train, I coach, and I meet and I mentor, that nobody owes you anything. The investors, the incubators, the accelerator programs, the ecosystem does not owe you anything. You start a business because you, as an entrepreneur, as a smart person, have the skill set, you have identified a gap, you have looked at an opportunity, you are empathetic, you want to solve a problem, and therefore you have created a product, a solution, something that can go out there, solve the problem of hundreds of people, and the process will help you to make money and create an impact. So investors don't owe you anything. If you think that I should be doing a startup, and I'm not meant for job, I'll do a startup because investors are paying you and you're getting money from the market. No, investors don't want you to start up, want you to do a startup. The only reason why you should be starting up is because, I'm reiterating this, because you as a smart guy, you as an aspiring entrepreneur, you as a startup founder, you have seen a problem, you saw a problem very closely, you have analyzed that there's a big market gap that can be fulfilled, there's a market potential, you want to fill that gap, you have the skill set, you have the right team to fill that gap, you can build a product, build a solution to fill that gap, you know how the opportunity looks like, and most importantly, in fulfilling that gap, in kind of capitalizing on that opportunity, you can then go and make money and create an impact and solve the problem of your customer. That's why you should only be able to start up, right? And last but not the least, the most important critical part, you should be raising money to scale up and not to start up. These are two very distinct and different uh, things, right? So when you are into very early stage, and of course, again, on my Instagram, go and check the post which says not every business is a startup. Not, and it's a misconception in everybody's mind that everything that you do is a startup. No, it's not like that, and I'll not be speaking about that. Either check the episode number 1 of AMA with DNK. I'm giving you references very required, or go and check out my latest Instagram post. But startup is a different methodology altogether, and scale up is a different methodology altogether. The kind of skill set you need for starting up or for scaling up, the kind of infrastructure you need, the kind of expertise you need, the kind of network you need, the kind of money you need, the kind of people you need is going to be absolutely different. You should be raising money to to scale up and not to start up. uh, to start up, if you need money, then I think you have not done your finances in a great way. And when I say when I'm using the word raising, I'm not talking about putting money from my own pocket. I'm of course talking about raising money from the market or raising money from the external investors, right? So I hope you are clear with these 5 myths. I just want to conclude this particular part by simply saying and simply telling you that funding is not a milestone. I've seen a lot of startup founders treating funding as a milestone, but rather funding is a milestone and not a destination. So I've seen a lot of startup founders putting in all their energy, effort, time into fundraising only, and they treat it to be ultimate success goal, which is not the case. Funding is the part of the process. It's a milestone in your long startup journey. Every time you raise fund, you owe it to investors, you need to become more accountable. So it's a part of the journey, it's not a destination, it's not the ultimate goal. See, so basically, the ultimate goal of your startup, or the ultimate goal of you as a founder, is to create a high growing, sustainable, profitable business, and of course solving the problem and creating an impact. These are the 5 things that should be a trait of an entrepreneur, and not the fundraising is a part of the process. It will come, it will go. It has got nothing to do with whether you want to raise money or not. Now, coming on to topic number 2, or broad area number 2, on which I want to talk about, uh, which is, as I said, at what stage it becomes viable for you to raise money, right? So I have seen people talking about, and it is nowadays, if you kind of find the right uh, way, you can even raise money at an idea stage, right? So let's talk about that a bit. And of course, now when you will hear this, you will say that, Dilnawaz, you're contradicting yourself. You said ideas do not get money, or ideas do not get funded. Most importantly, ideas do not get funded from a angel investor, or a venture capitalist, but ideas do get funding. So now we'll talk about the difficulty level. What do you need to raise money? So what are the basic and critical components that you need to raise money from the external investor, from market, from angel investor, from venture capitalist? And we'll analyze the difficulty level, and most importantly, we'll also see what are the ways you can raise money and how it kind of goes around it. So let's dissect this stage by stage. So stage number one is pre-idea, right? Where you are thinking of doing a startup. You might have one idea or you might have a few ideas and you're juggling between the ideas. That is the pre-idea stage, right? You haven't closed down on what idea you want to pursue or what business you want to build. In this stage, I think you don't need money. First of all, if you need money, you might be needing money to maybe do a survey or validate and things like that, and I think even the quantum of money you need will be very, very less. Some money, like which is going to kind of you're going to spend into operations of these things, can either be raised from friends and family, especially family. You can ask your parents to give you some money so that you can experiment, or maybe you can put the money from your own pocket or from your own savings. So this is pre-idea. Then comes the idea stage. Now this is very, very critical, right? So there are even two sub divisions when it comes to idea. An idea where you are alone with an idea, an idea with the team, right? That means you have a co-founder or you are 2 to 3 co-founders and who have done some sort of a background research, right? One, there's a higher potential of a team getting funding than an individual getting money at idea stage. I'm very specifically now talking about the idea stage. We're done with the pre-idea, we're talking about the idea now. So if you are at idea stage, there's a higher potential that you are not alone. There's a higher potential you will be able to raise money if you're not alone, but if you have a team, and you have a team uh, which has the right skill set, that it can prove it can kind of go and build this product and capture the market. It's a team with the comprehensive skill set, and it is a team that can be backed by the investors, right? Wherein if you are alone, single with an idea, it will of course will become difficult. Just a strict mark and a highlight point that I want to add: uh, how to find a co-founder, how to build a team, how to kind of build the first core team, how to hire employees. We will be doing a dedicated AMA on that in the coming few weeks, where I'll be talking about how to find co-founders, raising, building team, and all those kind of things, ESOPs and stuff. I will not cover that today, so let's park it for now. If you have any questions around that, don't post that today. Park it for now. So as I said, team. If you're at idea stage, you have two options: you have a team, you are without a team. If you are only single founder with an idea, I think again the best way is to either put in your own savings, raise the money from friends and family, or primarily family, because again you would need some money to validate. And last but not the least, you can raise money from an investor whom you know. So this guy uh, can be somebody who's a wealthy HNI who has extra money to kind of dispose of, and this person can give you some sort of a money if you have an idea, uh, primarily for the experimentation purpose, and you will be able to raise money that way. As I said, for team, it becomes very difficult. Again, you can raise money from your family. Most importantly, co-founders can contribute if you are a team, so that becomes another source of funding for you. Known investors, so if you know somebody in the network, they can give you the money. uh, but most important part, at an idea stage these days, you get a lot of prototyping grant. You get a lot of money from CSRs and grants run by private companies, and you can also get money from a lot of government-driven programs where they fund uh, not just entrepreneurs but also innovators to build prototypes. And then last but not the least, you can raise money via incubation programs or accelerator programs. So even there are dedicated programs now that fund idea stage teams. I will also tell why it's more difficult. I'll come on to that, but it's not that easy that it sounds, right? How it sounds. So idea with a team or idea without a team, as I said, go to your family, put in your own savings. Co-founders contribute. The investor, they will give you the money. You can raise the money from a grant or a CSR for prototyping. There's some sort of a government money which is available. Government has a launcher program, they can give you the money. Or maybe last is incubation program. Now, idea and team, and most importantly, you have built the prototype. This is stage number 3. So if you are somebody who has an idea, basically now you have a product built on top of that idea, and now you have a team. There's a much higher chance of you raising money, because there are several grants available from the government side, from the private investor side, from the a lot from corporate side, in form of CSR also, to do and conduct pilots. and it's a great way to showcase your product to people, and there's a high chance that you will be able to raise money in form of a pilot, or in form of conducting a small or small test around what you have built. So if you have a product, that means there's a much higher chance of you getting money or people preferring you. Now comes the last two parts, which is again much more easier to raise money in those cases, but makes the journey more difficult. So you have an idea, you have a team, you have a product, and now you have traction as well. That means you have done some sort of pilot, you have some sort of users of your product, and in that case, this is like a perfect fit or a perfect place where you can actually reach out to an angel investor or a VC or even to a government or to a incubator, and this is where they would be willing to give you money. This is the best fit or the best place or the best way you can start up. This is called traction. So one is traction without paid customers, and one is traction with paid customers. If you are a startup and you are in a traction with paid customers, I think nobody can beat you. I think this is the perfect place to be in. So if you have some sort of attraction without paid customers or with paid customers, traction is something which makes or breaks the entire game. This is where an angel investor or a VC would come. So, kind of summarizing it all together, at idea stage, the only money that will come is maybe from your friends and family, from your own savings, from your own pocket, or maybe a co-founder would invest, right? That is the only way you can get money at idea stage. If you and maybe there's a higher chance if you have a team, so some sort of an investor who might know you will give you money. Another way can only be that you can raise money for prototyping or product development from some sort of a government grant or some sort of a private corporate grant, right? The best way to raise money is to build a team, build a product, bring your idea to life, and most importantly have some sort of a paid or unpaid customer, do some sort of a pilot. This is the best time, best space to or rather the best time to reach out to an investor, primarily an angel or a VC, right? Now, uh, what do you need for fundraising, or what do you need to reach out to investors? Again, as I said, I have kind of spoken about this in my previous episode, which is episode number 5, around pitch decks. Go and watch that episode as well. But there are 3 critical components you need to have in place so that you can raise money. One is traction. Of course, I have already spoken about that in past 10 minutes. Why traction? Because traction brings trust. That means that these founders are not just they're not just fluking around. They have done some sort of a real groundwork, and they're trustworthy. They can be backed by the investor. Therefore, traction becomes a make or break, right? One. Second, of course, you will be needing a pitch deck to reach out to investors. So therefore, before you jump into the fundraising process, you need to create a pitch deck. Again, referring back to my pitch deck AMA and a few other videos on my YouTube channel, go and scroll down below. You'll find a few videos where you can find how to make a pitch deck, how to analyze customer profiling, and how to, of course, create a financial model for your business. And you can learn from those things, and you can learn how to create a pitch deck. And last but not the least, once you have traction that proves you are worthy, you have pitch deck, which is the required tool to raise money. Last is you need to now find investors and basically reach out to them either via incubators, demo days, competitions, things like that. So 3 things are very much required before you jump into your fundraising journey: traction, pitch decks, and demo days, right? Okay. Now, uh, another important thing that or another important question that is again and again asked by a lot of startup founders is that should we even raise money or not? And if we raise money, when should we raise money, or what is the right time to raise money? This is again a point of confusion because uh, fundraising or raising money technically is a full-time job. I am not against taking support for creating a pitch deck or taking advisory or helping or asking somebody to help you in creating a business model, or asking somebody to help you with the fundraising journey. I do it as a part of my job. That is what Power Deck is built around. We help startups create pitch decks. But uh, the ultimate pitching to the investor has to be done by the founder or the co-founders, right? The ultimate pitching to the investor, the ultimate reach out to the investor will have to be done by a founder or co-founder, or maybe via some sort of an investment banker or some sort of an incubator. Those are the layers. You can never, or it is rather, doesn't leave the good impression that you hire an external consultant to do fundraising for you. It is extremely difficult and also unrealistic. Even the investors will not entertain you, or uh, will not you'll not be portraying a very good picture in front of investors if you do that, right? Basically, they'll not even listen to the consultant, right? So where you should hire somebody for external help, or where should you hire a consultant? You should be hiring a consultant, or you should be hiring an advisor or a mentor who has the experience of fundraising, who can guide you through the way, who can help you with pitch decks, who can help you with the financial model, who can help you with the business model, who can help you with business strategies, who can help you with identifying the right investors. Because investors, not every investors again is a good fit for you. There's an investment thesis that goes by, there's an investment criteria that goes by, there's an investment quantum that goes by. So many things are there. So consultants are a great fit and a great help in that case. But as I said, pitching ultimately and reach outs have to be done by the founder. That's the right way. Now, when I say this means that creating a pitch deck, modifying the pitch deck from time to time, and then reaching out to investors, going and delivering presentations, whether in a demo day or in front of an investor, going for marathon meetings with investors, it is a full-time job. And therefore, if you are a team of two, or if you're a team of three, one guy from your team will be investing all his time in just chasing investors, right? So therefore, it's an expensive trade-off for you as a startup. So whether you should be focusing on sales and raising money, raising money from the customer and building the product and putting the energy there, or should you be rather not doing sales and other operational level activities but raising money? So it's a big trade-off. And imagine if you're a single founder, your life is screwed any which way, right? You will not be able to kind of tackle all these things. Don't quote the examples of likes of Vijay Shekhar Sharma and Ritesh Agarwal. They are absolutely different league. We will pick up their case study sometime later, but they are not this kind of a fit here, or will not fit this particular example, right? So therefore, the questions come: should you raise money or not? And if yes, then when and how much and how? Right? Let's answer that. So one, as I said, you should be understanding, and you should kind of put this clear in your mind that fundraising is a part of the journey. It's a milestone and not the ultimate destination. And also the ultimate goal of fundraising, ultimate goal of building the startup, and I've already spoken about this, should be ultimate I'll repeat this line. I got confused, my bad. As I'm saying, the ultimate job of the entrepreneur or a startup founder should be to build a sustainable, scalable, growing, impactful business, of course, and with relevant profits. But in time, you need to break even at some point in time. That should be the ultimate goal. So therefore, fundraising is a part of the journey. So one, you should not be only relying on fundraising, and you should not be only chasing the fund. So what is the right time to raise fund? The right time to raise fund is when you think, or when you have validated your idea or validated your business model. And if not, if you are a step ahead, it's better. You have bootstrapped your way across, you have built the MVP, and you have identified something called as a product market fit, right? That is the best time to raise money. Because, I'll just say one word: the objective of raising money is to grow, is to scale. You, as I said, you do not raise money to start up, you raise money to scale up. So objective of raising money should be scaling up and not starting up. And therefore, the best case scenario is, should you raise money? Yes, you should raise money when you want to grow, or you want to grow rapidly at a rocket speed, and that is the time you should be able to raise money. Before that, if you are able to sustain yourself, if you can bootstrap, if you can build the MVP, if you can build a product market fit, if you can find the product market fit, I can assure you, you will have a better negotiation power on the funding table with the investor. You will be losing less equity. That means you will be losing less ownership and less power relatively if you raise the money earlier. So the later you raise, the more you can negotiate, bargain, and you can retain more power and have more things in your hand, right? And to learn more about bootstrapping, partially MVP, survival strategies, how to bootstrap, what are the tips and tricks, check out my previous episode, which is episode number 6 on survival strategies for startups, right? Go and check that out. Right. So I'll again quickly take a 10-second pause here. Let me see if I have got a few questions. Uh, okay, I have got one question from Ashish. Ashish, thank you for sending your question. I will be picking up it in some time. Okay, now moving ahead. So now once we have spoken about the myths are clear, the the process, the journey is clear, things like that are clear in your mind. Let us now look at the startup journey and break it into multiple parts, and let's see the common terms that revolve around. So right from the idea stage to the ultimate IPO stage. So IPO is initial public offering, where you become the ultimate market player. You get listed on a stock exchange, or you get listed on the market. You become a public company, and therefore, kind of, I think that's the ultimate dream of every entrepreneur, to either do an IPO or get acquired. That's the exit strategy. We'll talk about that later on as well. So there are multiple stages between that as well. So one is the initial idea or very, very early stage, where you have an idea, you build a product, and that is the time where majorly the money comes from accelerators, angel investors, friends and family, and seed capital. Then you move into the early stage of the company, which is phase 1, phase 2, where typically you get VCs, you have money from early stage angel investors. And then in the later stage, which is you can understand that as a series ABC, that is where you get money from the VCs, or that is where you get money from institutional investors, right? And then of course, post that, if you grow and if you scale really, really big, you can go and do an IPO. That is you can go and list yourself in the market, and you basically give everybody an exit, and everybody's happy at the end of the day. That is how the entire startup journey works, right? So now let us look at important words in this entire journey that will define how much money or what money do you need, or what is the requirement of money. So one word that a lot of you have been hearing and a lot of you might be confused about is called seed capital, right? Or a few people also say pre-seed, right? So you can use the word seed or pre-seed, they're almost equivalent. So seed capital, seed money, or seed is basically that small token amount of money, ranging from couple of thousands to couple of lakhs, less than 10 or 20. It's a very small amount of money that is put into a startup to validate the idea, build the basic product, build the basic team, and see even what you're trying to do works or not. This money is basically, as I said, either comes from the founder's saving, or co-founders contributed together, or is kind of you can also crowdsource. That's a different topic we'll talk about in some time. Or you get it from friends and family. In rarity, you get it from angel investors, and as I said, last, a few of the government programs and few of the private corporates also run programs where they give you seed capital. So seed capital, just to give an example, just like if you have to grow a plant, you put a seed in the mud, and then the plant grows. That is the analogy. That is what is called a seed capital. The initial money that you put into the business to validate and see whether it works or not is called seed capital, right? Second money, after seed, you get into the angel space. So angel investor is angel investor or angel investment is anything that so these are not absolute benchmarks in terms of the number I'm saying. So don't come to me tomorrow and say, hey Dilnawaz, you said that anything from a 50,000 rupee to a 10 lakh rupees is an angel, is a seed, and my angel investor says I'll give you 5 lakh rupees. The lines are blurred. These are gray areas, but these are broad benchmarks, and these are broad parameters. I've seen a few institutional angels putting in money up to a couple of crores as well. So there's no bottom line, or there's no absolute demarcation between the amount of money, as per amount of money, right? So second is angel investor, angel investment. So angel investment, again, to give an analogy, just like an angel who would come and who would save you and will grant your wish, Angel investor is basically an external guy. He's typically a wealthy HNI who has some extra money and he wants to dispose, and he will give you this money in terms of equity in a company typically. And this is a very high risk capital. That means the earlier you are as a startup, the higher chance there are higher chances of you failing, and therefore the higher the chance of failing, the higher the risk the angel is taking. Therefore, it becomes a high risk capital. So this guy typically puts up money into a company in form of equity, which is basically you divide the ownership, or into convertible debt or debt. I'll come and I'll decode these words later on. I will be speaking about equity, debt, convertible debt, and other instruments of funding later on in the session. Let's understand the words right now. So as I said, angels are typically, it can be a one person who's wealthy HNI, and sometimes now in the modern world you will see angel investor groups, right? So you'll find something like Indian Angel Network or Mumbai Angel Network or Chandigarh Angel Networks, or maybe in Rajasthan you have something called as Wherein Rajasthan Angel Investor Network, and then you have something called as the Harvard Angel Network, Stanford Angel Network. So a group of angel investors working together to fund startups is called an Angel Investor Network. That is a way you can even raise a bigger round of angel, like a crore or something, right? Now, third stage is where you get into really serious, deep shit conversation, right? And this is the venture capital. This is where you get into the serious kind of business. This is where you get into the big boys room or big boys conversations, right? So venture capital is basically any sort of a private equity financing that you raise either from venture capital firms, or maybe some sort of investment banks and other organizations like that. In fact, institutional angel investment is also kind of partially be called as venture capital or venture investment or private equity investment. Again, the lines are blurred. I'm not a finance professional, but these are broad terms and broad jargons and broad analogies you should be able to understand from the startup point of view or an entrepreneur's point of view, right? So venture capital is anything where you raise a bigger round of money. Typically it comes post your post your angel round. So you have pre-seed or seed, you have angel, then you have a venture capital. It's a private equity investment or private equity financing, and it's, as I said, done by either a group of angel investors or really big angel investment banks or other financial institutions. So these are the three ways of raising money. And of course, I think I've already spoken enough about grants and all those sort of things. Now, there are multiple ways through which you can raise money, or multiple modes through which you can raise money. So let me first tell you the broadest way how we see investment happening, right? So there are two ways primarily. One is a loan, and another is the division of ownership, which is called equity. So you as a startup, when you take a loan from somebody, you are basically borrowing the money, which is basically the principal amount, and you return to pay back some sort of a return on the investment, or some sort of a kind of a interest. Basically that's the right word, interest on the principal that you've taken. So if an investor gives you 100 rupees, he at a 10% annual interest amount, you have to return him 110 after 1 year. So what if the startup fails in that case after raising a debt money or loan? uh, if as a startup you raise debt capital or raise debt or raise loan, and if you fail, you are still liable to pay back the investor's money because you raised the loan, right? You still owe the investor the money. And typically this sort of a money comes from a few angel investors, primarily from banks and NBFCs, non-banking financial corporations, who pay to small businesses and startups to start the business or to scale the business or to manage their operations, right? The advantage of raising debt capital is that you don't have to dilute the ownership. That means you are still the sole founder. So that means that the investor does not have any say into who you are, what do you do, and how do you do. Tomorrow you want to scale, you don't want to scale, you want to shut down the product, not shut down the product, change the product, change the business model, and in everything depends upon you. The investor does not have any say in the entire game. Wherein in case of equity, which is sharing of ownership, you basically give a part of your company to the investor in exchange of money, and the part of the company that you give to the investor is basically called share or stocks, right? So this is the second form of investment, which is called equity investment. Most of the venture capital firms, most of the, in fact, angel investors work on this particular model, that is equity investment. So and again, I'll not go into the compliance part. As at a ground level, at the basic level, you have to be a private limited company in order to raise angel money on equity. I will not get into this complication, and we'll have this compliance discussion sometime later on. But again, as I said, in the survival strategy, I said, if you're into validation stage, if you're piloting, if you're testing, do not register a company, only register a firm, right? Because firm has lesser compliance and it's easier to shut down. Company has a higher compliance, difficult to shut down. But if you have an investor who's going to pay you the money, you definitely would need the private limited company. And of course, the company can be opened in 72 hours. That's a different discussion altogether. If you have any questions around that, DM me on Instagram, DM me on rather, of course, the live chat will be over after the session. But of course, DM me on Instagram. We will talk about that. I can guide you on that. But coming back to the point, the second form of investment is equity. What happens in equity is basically you register a private limited company. What do you mean by private limited company? Is that company is limited by the number of shares. Therefore, if let us say you treat company as 100, and if you divide 100 company into 100 parts, there are 100 units of company you have. And therefore, if you give your investor 10 units, he becomes a 10% equity holder or 10% owner of the company. The good part of raising equity money, especially in a high risk case, is that if the company shuts down, the investor money is gone. You need not pay him back even a single penny if it's equity money. But the bad part, or the con of this entire thing, is that the investor becomes a board seat holder in your company, or and also might interfere in your decision making, because he is now a part owner. And therefore, in that case, the decision making, the veto power, the board decisions have also be run through the investor. So therefore, it's a call of a startup founder what direction you want to go into. But don't get scared from when I tell you this, that investor might interfere. That is how all your big companies work. Just to give you a classical example, and not to just scare you, but just to kind of tell you, this is the reason why Steve Jobs got fired from his own company, because he raised so much of money that he had to keep on giving in ownership to multiple people. And once you have enough people on the board, they might fire you as the CEO, which is the operating position, and not as a shareholder. And again, I will go into some other time, I'll go into this detail later on, that what's a shareholder, what's a employee position. Those are different things. The bottom line is, equity is better if you are raising money to scale. Debt is better if you are raising money to operate, right? Okay, now comes the modern and much more complicated part. Yes, Keshav, thank you for the question. I'm coming on to the convertible note now. That's the next thing I'm going to talk, because I want to first clarify the basics and then move on to these. I'm just reading the question on. Sorry, guys, I just had to turn my head. I'm reading the question on the monitor. Okay, so convertible notes. So the biggest problem with debt is that founders don't want to take debt because it makes them liable. The biggest challenge with equity is that if you raise equity money, uh, you will have to go through a lot of compliance, that is registering a private limited company, and then of course distributing shares, and then signing the shareholders agreement, which is SHA, and then modifying the MOA, which is memorandum of association, and a lot many things like that. So therefore, if you are a early stage company raising money at an early stage, and if you're raising some money, uh, it becomes difficult to enter into this entire compliance zone from the founder and also investors point of view, right? Nobody wants to get into all these hassles. So to simplify all these things, you know, there's something called as convertible notes that were introduced. So what is convertible note? A convertible note is a short term debt. It's a debt funding, but it converts into equity in the future, right? So it is a note. So convertible note is again an instrument, just like a share or a debt. It is not a physical paper. It's a form of investing, right? And any finance professional will be able to help you understand. But a convertible note is a form of investment in which basically you take a debt, but it's not a liability debt. It is going to convert into equity in future, especially and typically in the cases when the startup founder raises next or next to next round of money. This helps startup founder in a way, because in the way that he gets the money upfront, and he does not have any liability of debt, nor he has to enter into the compliance or the complicated process of registering a company and dividing the equity. And the benefit to the investor is that any which ways, if he would have won, if he would have gone into the equity mode, he would have lost his money. So he has rather given a debt to the company, and he can then bargain in future at a better valuation, better pricing. So it is more or less like a win-win for both of these guys, right? So investor loans, but when at the time when you have to convert, the valuation at that time is brought into consideration. Therefore it is beneficial for investor also. So therefore a lot of people now prefer convertible notes as the form of funding, right? So as I said, I can maybe read it for you. So it's simple structure. It has got fewer complications. The main benefit is that it is simpler, reliable. It can make the turnaround for investment very very quick, and therefore it's a preferred mode. Another very interesting thing, Rishabh, sorry, Keshav, I hope this answers your question. If you have any more questions, feel free to ask. And any which ways, I was about to kind of answer about the convertible note. Any which way, so good time to ask a question. Okay, but beyond your convertible note, there's another instrument which is called safe. And then there's something called as iSafe, which is specific to India. That is also something you should understand. So safe is almost like a convertible note, but not exactly a convertible note. So safe is called as SAFE, simple agreement for future equity. It is not even a convertible note. It is more or less like a MOU. It is like an agreement between the investor and the company, that I am going to give you money at this point in time, but the equity conversion will happen in the future on the basis of the valuation, right? So it I know it would sound like a convertible note, but it is not exactly a convertible note. In a safe mechanism, what happens is that later on, once the dilution or liquidation event occurs, that is the time the investor gets the money. And as the definition says, it is not directly a debt. It is I don't know, it is a grant, or it's just a commitment that happens. And iSafe is basically India simple agreements for future equity. One of the startup investors network called 100x VC uses this particular form of investment, or kind of a mode of investment, to put money into the company. You can go to the website, have a look at it. So these are two things. As I said, I'm not going to get into complications, because as I said, most of the people are going to watch it, and it is the first time I'm talking about the art of fundraising. It will be very complicated. I will definitely in future rather host a session number 2 around this, where I take you into the deeper conversations around stocks and safe and iSafe and convertible notes and all these areas, right? Okay, so now let me see. Okay, so as I said, I have of course, as I've already said, that I will be speaking later on stocks, ESOPs, shares, and valuation. So I'm not going to cover, of course, all those topics. They're a little far-fetched. You might not be able to get valuation right now, because the moment I start talking about valuation, you will ask me what's term sheet. The moment I tell you about term sheets, there are hundreds of kind of definitions and things in term sheet that you would want me to answer, right? So I'm not going into the jargon or the terminology right now. We will definitely have another round of conversation where I'll let you know when I'm hosting this, which will more or less the art of fundraising part 2, or probably it will be like the more complicated version around funding, and then I'll be talking about stocks, ESOPs, and shares and valuation, right? Now, coming back to other modes of fundraising, and I think I'm sure. Let me check once again. I think I got 2 more questions around that. Okay. So another question from Keshav was that tell us how student entrepreneurs can reach investors. And another question that you have asked is, which is the most important slide in the pitch deck to show to investors while raising money. Keshav, give me a minute more. I will come on to these two questions and I'll answer both of them for you. But before that, and I think this particular point that I'm going to talk now should be able to answer the first question of yours, that how do you reach investors. So before I tell you how can you reach investors, let us also look at what are the other ways of funding, right from and also do a relative risk analysis of all these funds, that what is a high risk fund and what is a low risk fund. So the best way for any founder to kind of put in money into the company is generally his personal savings, and that is where you start from, or friends and family. So either you are able to raise money from your friends and family or your or personal investment. As I said, another great way of getting money is through co-founders, and when you are getting a co-founder, based on the co-founder's skill set, co-founder's kind of work, the kind of value he brings to the table, and the kind of money he brings to the table, you can divide the percentage of the company. And of course, again, that's a separate conversation for another day. So personally, you can put in your own savings. You can again, you can consult, raise money from parallel other options, make money from other places, put in the money into the company, bootstrap. Spoken about this into episode number 6, survival strategies for startups. Go and watch that after this. Friends and family and personal savings and co-founders, right? uh, Another very cliched and important thing we have already spoken about, angel investors, angel groups, venture capital. That is another way you can raise money. Then of course, if you want to raise debt money, primarily working capital, or some sort of a loan, you have bank loans, you have line of credit, and you have credit cards where you can pick up the loan, pay it later on. uh, there's another way from where you can raise money. It's crowdfunding. So crowdfunding has become in these recent days, if you're launching a physical product, and if you can create a campaign or a storyline where you convince people to give you the money before even the launch of the product, that's crowdfunding. And connected to crowdfunding, another great way is pre-sales or pre-launch discounts. We have seen it happening with lot many companies, right from your Apple to Tesla, and even a lot of small niche makeup fashion companies have tried this in India. You can definitely think about launching pre-sales campaign or pre-launch campaigns where you give such certain sort of a discount, or maybe some sort of uh, additional benefit to the person who's buying your product earlier. So that's a great way of raising capital. Of course, this is not the way to build a startup, but it's a great way to raise capital and raise money. Another way you can raise money, which is fourth, is grants, CSR, and competitions. So a lot of colleges host competitions, a lot of colleges host student exclusive competitions, a lot of corporates host student exclusive competitions. There are a lot of programs where you get grants from companies. There are a lot of programs where you get CSR money. Corporates host a lot of programs where they give you money to prove prototype, pilot, those kind of places, so you can raise money. Last but not the least, and the most exciting one, and irrespective of whether you're a student or not a student, I think another best way to raise money is to reach out to an incubator or an accelerator, something like a Y Combinator. It's difficult to crack. So the admission rate of Y Combinator is lesser than Harvard, but and you can therefore understand the competition which is there. But as the initial joining seed grant, you get $125,000, 1 to 5K dollars, which is roughly 100K would be 70 lakhs. So approximately like a crore rupees is what you get initially. But concluding all of these points, and concluding this particular part, as I said, uh, because there's so many startups and so many smart startup founders in the market, do not think that people will listen to your idea and will give you money at an idea. Raising money at idea stage is becoming difficult day by day as we are moving ahead. And now, when in the time of pandemic and in times of corona, when things have really gone difficult, startups are dying every day. Investors are choosing and putting in their money in the right place. So raising money at an idea stage becomes far more difficult, and technically impossible, until unless you do not have access to some sort of a seed money, or you do not have access to some sort of a competition, a grant, or some sort of a you don't get selected into some sort of a government funded program, it is absolutely difficult for you to raise money at an idea stage, right? Last point I want to talk about is, and I think before I jump into more picking up more questions, okay, I think I have two more questions and then I'll wrap. Is that cost of raising money? So I think I have partially covered this earlier, that when you are raising money as a startup, of course you are low on resources. There's less time, less money, less energy. No, not the energy, but less money and less resources. You are not like a multi-billion dollar company. You're not a startup, you're not a Reliance, you're not a Tata Enterprise, that you can put in or deploy infinite resources and get the job done. So therefore you're scarce on manpower, you're scarce on money, you're scarce on resources. So you need to analyze the cost of raising money as well. If one of your founders is full time into raising money, and if he's not able to raise money, technically somebody has to compensate for that. So raising money has its own cost. Analyze that. Most importantly, equity money is expensive than debt. Every and any money that you raise for the company has a cost attached, and it is not monetary cost I'm talking about. So every time you raise equity money, you technically become a lesser shareholder, and also you give away a certain part of your power from the company. This is the reason why, as I said, Steve Jobs got fired. Sachin and Benny Bansal came down less than 10% of the combined equity in the company, because the moment you start raising more and more and more, you have to lose out certain part of your company, and with the amount of equity going out, you also lose on power. But that's the trade. You can build a 10 crore company and be 100% owner of it, or you can build a 10,000 crore company and be a 10% owner of it. You need to choose what path as an entrepreneur you want to go, and therefore it's a trade-off you have to pick up. Last but not the least, as I said, credit card money is very expensive. Do not try and get into the credit card trap. I have been there personally. I can tell you from my personal experience. I took a couple of loans on my credit card back in my first company, and until like 4 or 5 years down the line, I didn't realize, or I was not aware that you basically pay 36% interest on your credit cards. So as an entrepreneur, if you're into early stage, loan on credit card should be your last option. Do not try and get money from credit card. Three things you should do: put in your own savings. If you don't have savings, get money from your parents, your friends and family. Try and convince them and take money. uh, and last but not least, get a co-founder who can bring in the money. If not, go to government grants and competition. And if none of this is possible, try and consult and advise and have some kind of a secondary income from where you can survive your own self, and of course put in some money in your business, in your company, so that you are able to kind of build the startup that you want, right? Okay, so I think this particular thing cover this particular section covers all of these basic structures, myths, pointers around art of fundraising. Kind of just to summarize it all, and in a nutshell, if I can quickly tell you, if you're a traction based startup, it's better for you. So you need to have a traction, you need to have pitch deck, and you need to find investors to kind of raise money. Go to demo days, apply to incubators, apply to programs, apply to government grants. Do not raise money unless you do not really think you need it. Do not get into the loan trap. And of course, see how much you need. And of course, if you need any other suggestions, feel free to, of course, as I said, DM me on Instagram. I'll quickly, once again, before I conclude, put in these banners so that I can tell you where you can go and find me. But uh, you should go and watch the 6th episode, where I talk about survival strategies for startups, where I talk in detail about what all things can you do, uh, so that you are able to at least bootstrap or make some sort of a money, so that you can survive your own startup journey. And also you should go and check out a 5th episode, where I talk about how to create a pitch deck and what are the pitch deck fundamentals. uh, Last, I'll answer this question that I've received, and then we will wrap. So Ashish is a question that I totally agree with you, but there's a lot of entrepreneurs in the market. Those have potential, skills, and good idea, but they don't able to start the business because of lack of money. Okay, I think if it's not a question, it's more like an input. But Ashish, that's the sad reality of life, right? a lot of talented people do not get a platform because they don't have connections, they don't have resources. But either if you're really an entrepreneur, you will have to fight your way up. It might sound like motivational or inspirational, or maybe just like a cliched advice, but that's the most honest truth I can tell you. It doesn't matter what skill set you have, it doesn't matter what potential you have. If you're an entrepreneur, you have to fight your way back up, and entrepreneurship is the most difficult form of getting up on the top. So it's a difficult journey. So nobody is sitting there for you with the bed of roses that one day will come and things will be given to you. There's no throne. uh, it's a tough journey, it's a difficult journey, and an entrepreneur should realize and analyze, and then only he jumps into it. Yep. So, all right, that's it all from my side for today. I think I have covered most of the things around art of pitch deck. Sorry, art of fundraising. My bad. If you, as I said, concluding, go back and check out all the previous episodes of AM with DNK. We do it as a weekly series. Uh, so yeah. So once again, thank you so much for joining me on the seventh episode of AMA with DNK, which is Art of Fundraising. For all those who do not know me, I'm Dilnawaz. I'm the founder of Codesign Labs and Power Deck. I'm an entrepreneur with almost roughly 12 years of experience across design, incubation, and tech industry. I have some sort of a I have been into the I've been into the startup ecosystem also from roughly 10 years. Been a part of multiple platforms, incubators, accelerator programs, and the reason I host AMA with DNK every Saturday night on Saturday Night live stream is I want to come and talk to all of you about startups, pitching, fundraising, and of course help you to answer your questions and help you to ease out your startup journey. So yep. So if you watch this, if you're watching this right now, fantastic. If you watch this later on, go and subscribe to my YouTube channel. I'm making all these videos every week, and make sure you also press the bell icon. Go and follow me on Instagram and the social media channels. I will see you next Saturday, basically next Thursday on Cracking the Code, and of course the next Saturday 9 p.m. See you next time, and meanwhile, bye bye. Have a great weekend, and once again, happy Independence Day, guys. Thank you so much for joining today on AM with DNK. I'm Dilnawaz signing off. See you next time.